Welcome to the B.F. Anderson Technical Report for April the 19th. Now, there's a lot going on right now. There's a lot to cover, so I apologize for the length of the video. But there's a lot of under-the-radar things that are happening here that I think are quite bullish and quite optimistic. You know, we've had a correction here. The market, as we know, we had a primary up move here that started last year, peaked right at the end of January. About an 11% correction in the S&P, rallied to a lower high, and then failed to break to a lower low, which is very good news. Basically, we have a double bottom here at the 200-day moving average, which tends to be an important level. So the question we have to ask ourselves is that are we going to pay attention to the volatility, or are we going to pay attention to the price trend, the long-term trend? So one big mistake that a lot of investors make, including myself, is we tend to extrapolate the current situation into a long-term situation, and that's just a tremendous mistake because we really don't know what this thing is going to do. But right now, what's happened is we pulled back on the second bottom. We're now making lower lows and higher highs. So that is looking somewhat like a reversal of the downtrend, and maybe the correction is over. Now, under the radar, as I mentioned earlier, there's something going on here that I have not seen in a very long time, and that is an outperformance by the S&P 600 small cap index. These are the small companies. Now, if you think about it, the economy started to go bad around 1998. Then we had a bad recession in 2000. Then we started a mediocre recovery that ended up in a mortgage situation in 2007. And then we had depression number 2 in 2008. And so since 98, the economy has basically been bad. Now, all of a sudden here, since the election, and really kind of going back to the summer of 16, corporate earnings started turning up, and interest rates actually started to turn up as well. And it kind of looked like maybe there's something going on economically here, and we're starting to see improvement and recovery. So the reality of this is that the small companies in a difficult economic environment are not going to do well. They just can't compete. So what's happening here for the first time, I would say since 98, the small cap stocks are starting to lead the market. So in other words, there could be some explanation for this, which would be with all the international stuff going on with the tariffs and so forth. These small companies tend to be more domestic, therefore you don't have the international problems. But the point I'm making here is, whatever the reason is, the small caps are hitting an all-time new high, when if you go back and look at the S&P 500, which is this index, it's nowhere close to a new high. And this is the large stocks. And the name of the game is to find something small that's going to become big. So this is really a very important thing to understand. Now let's define the primary trend as we are today. Focus on the primary trend. Today, the primary trend is bullish. Don't extrapolate. This is very clearly what we've got here is the 10-month moving average compared to the 20-month moving average. And I'm going to go back and show you some examples of this in the past. But don't ignore this. This is the primary trend. So if you get into these short-term corrections, which we've had here since January, it can really throw you off. So the real thing to do when the primary trend is up is to look for the next apple. So let's kind of go look for the next apple. Let's take a minute and do that. Well, let's find the first apple first. So here we go back to 2003. We get a what we call a golden cross, just like we're on. This is where we are today. But if we go back to 2003 and we look at the golden cross here, you had about a 4-year run here. We went from 04, 05, 06, 07, 08 was all bull market. So we right now we're a year and a half into this buy signal, this golden cross. We're about a year and a half into it. We could easily go another 3 or 4 years. No guarantee, but that's just something to be aware of. So you want to focus on the primary trend. Volatility is normal. It's the way markets work. And like last year was an easy year, low volatility. Well, that's going to be followed by a difficult year, high volatility. It's just the way it is. Volatility makes everybody feel uncomfortable, and volatility is not the enemy, and all markets are volatile. I don't care if it's oil, I don't care if it's gold, I don't care what it is. Every market is volatile, and that's just the way markets work. Now, how do we find Apple? Well, first of all, we know that the primary trend is up in 2003. Apple hits an all-time new high right back here in May of 2003. We bought the stock at that period. And Apple at the time was a $35 billion company. All they had was iMacs, which are computers, and iPods, and we had no idea they had a phone. No, just no idea whatsoever. But we knew that they had real good computers. That was about it. So if you pay attention to this, and you're always looking for the great stocks, always look for the great stocks during an uptrend. Now, let's go back and look at the index itself. This is the S&P 500, 2003. Very similar pattern to what we're looking at here. 2003, if you stuck with that year, just the S&P in 03 went up 26%. And it started as a very difficult year with lots of volatility, lots of whipsaws. It says, most years are difficult, and it's just the way the market works, and it's not going to change. This isn't going to change. So the worst thing you could do here is, okay, we start the year out strong, just like we did this year. Then you go into a correction. You make a low. You break the short-term trend line. Then you break to a lower low, and then the thing flips and goes into a bull market cycle. This is the 200-day moving average. We break back above the 200-day moving average. So the worst thing you could have done here was to extrapolate that this was going to continue to go in this direction. You don't know that, just like you don't know it's going to go in this direction. But the point is that you found Apple in a year where the primary trend was up. So let's take another example. Here's 1995. Okay, so we get a buy signal on the primary trend early in 95. What did we find? We found a company called Cisco Systems that around mid-95 hit an all-time new high. So the moral of the story is you want to buy high, sell higher. You don't want to buy low, sell high, because buying low, you're trying to catch a falling knife. But look what Cisco did over that period of time. And I want to call your attention to this as well. Once we got the buy signal on the primary trend, which is the 10-month versus the 20-month, and I've removed the index, it's nothing but the moving averages, you got a 1, 2, 3, 4-year bull market. So we're a year and a half into this one. Let's just hope that we've got another 3 to 4 to go. Now here's an example of a primary trend going bad. This is what we call a death cross. This is 2008. This is April of 08. And I'm just going to tell you that you just quit looking for apples in something like this, because you got to have maximum defenses on at this point. Ignore volatility. Look at the primary trend. If the primary trend turns down, nothing works in a bull market, therefore cash is primary the way to go. Now, what are we seeing out there right now? And this one makes the top 5, which we'll get in here in a second. But I just want to give you an example of a stock that's really kind of looking like Apple and Cisco looked back in those years. And if you think about Apple and Cisco, what is the main thing they have in common? Number 1, their stocks hit new highs. Number 2, the primary trend was up. And number 3, they were in technology. So when we look at a company, we look for new highs. Look at this company. This company is making a new high. They're involved in technology. They're involved in cloud computing. We know what the numbers are. They got 21 analysts following the company. They're all estimating that on average, the current quarter is going to be up 55%. Next quarter is going to be up 61%. And for the year, earnings are going to be up 55%. During the correction, this stock held up incredibly well above the 25-day moving average, which tells you that the stock is in strong hands. So this could be a future blue chip. We'll see. So the main thing to realize is that while the primary trend is up, like it is now, you want to look for stocks making new highs. Now here's Abercrombie & Fitch. We're seeing retail. Retail is actually one of the strongest sectors that we're seeing right now. Here's Abercrombie & Fitch. Recently hit an all-time new high. Here, and also we're also seeing improvements in energy stocks. Even Exxon's starting to rally a little bit here. But here we have Continental Resources, an exploration and production company, all-time new high. Here is Etsy, which is a e-commerce platform, just recently hit a new high. Nutanix, which is one I just discussed, just hit a new high. And the main thing is this: these are all small caps. These are all small and mid-sized companies. So we've got a fighting chance here to find something small that's going to become big. Apple was small when we found it. Cisco was small when we found it. So we're seeing something very, very important here. Now here's another retail stock, just to make the point on retail. Urban Outfitters, all-time new high. So we're hitting new highs. A lot of stocks hitting all-time new highs. We're seeing the small caps lead. If this was a bear market, or if we were rolling over here, I don't think this would be happening. But give me a call if you have any questions. Thank you very much.